Let's talk about Tilray Brands stock today. So it's down about 20% posted earnings today. And the big headline was that its revenue missed expectations. But let's take a closer look at the actual results to see how it did. So Tilray reported its earnings and it said net revenue 188.3 million was up 30% in the third quarter compared to 145.6. Now, the one thing you should know about Tilray is it's been basically growing its revenue via acquisitions for the past few years, whether it's loading up on alcohol brands or cannabis companies. That's been the main way it's been growing. Just because the cannabis industry in Canada, it's really competitive. You can't really advertise or do any marketing whatsoever. It's really hard for a company to generate any organic growth, and it's not like a big brand can dominate by being seen and people recognizing its image because of the restrictions in Canada. It's actually really difficult for them to benefit from that, even if they were the top brand. Like they like to say, they have number one market share in Canada, but it's a really fragmented market in the sense that it's really hard for any one company to dominate. Because if you go to one of those cannabis shops, you basically have to know what you're looking for. It's not like you go into a store, you can see a logo that stands out. You can see, okay, that's Tilray's brand. Okay, that's the brand I want to buy. It's not that simple when it comes to that. So that's where the competition is really hard, and that's why the Canadian market is just not a great one when it comes to cannabis. And if you look at their revenue, like we see cannabis net revenue increased 33%, but that was largely reflecting the acquisitions of Hexo and Truss, right? So again, largely to do with acquisitions. And Hexo isn't exactly a top brand in the cannabis industry to begin with. I mean, a few years ago, there were concerns about the company's future. An auditor raised substantial doubt about its future just because there are concerns with its internal controls, financial reporting, and so it just wasn't in a good position. But Tilray acquired it anyways, again for the sake of growing its market share, which can be one way to sort of manufacture growth, but it's not going to make a business necessarily more profitable or better off. Same with its beverage business. So these days, Tilray Brands is becoming more of an alcohol company than it is a cannabis one, it seems. And at some point in the future, that'll probably happen where it's generating more revenue from alcohol than it is cannabis. So again, their beverage revenue was up 165%. Again, increase was related to our new craft acquisition brands. And so this was related to an acquisition it closed in October 2023. So it bought a bunch of brands from Anheuser-Busch, so all these different brands, to grow its market share. And so again, that's the main reason why the company's been growing. And if we look at their actual revenue breakdown, we've got cannabis is still the main one that's driving most of the revenue. Here we got cannabis business 34% of revenue. You see beverages and alcohol 29%, so really close. The distribution business, this is their stuff in Germany, where they distribute pharmaceuticals, that sort of stuff. So it's 30%, and they've got a wellness business that makes up 7% of the revenue. So in one case, you can say that they're fairly diversified. That they're generating revenue from a lot of different places, but it's still a lot of that growth is coming mainly due to acquisitions. And the one concerning thing that if you were looking at this company is that its gross profit is fairly minimal at 49 million. I mean, it was negative a year ago. And when you compare that against general admin, selling, marketing, promotion, that's already well above that figure. So the odds of this company turning a profit while it's also loading up on other business isn't very high. They're a pretty risky business to invest in just because their optics, their margins just aren't that great. Because a lot of times when you see these marijuana companies talk about earnings or profits, they're talking about adjusted numbers, adjusted EBITDA, adjusted gross margin. They They rely heavily on adjusted numbers. And if we look at their actual cash flow, one concerning thing is that their cash flow from their operating activities, this is their day-to-day business, is negative 61.6 million. That's up from 35.69 million a year ago. So they're burning through more cash, right? Because those acquisitions that they're picking up aren't necessarily that great. They're going to require cash infusions. There's going to be inefficiencies. So that goes back to, okay, they're manufacturing growth by buying up market share, acquiring these companies, but they're not necessarily in a better financial shape overall. One thing to also be careful of is that Tilray and a lot of these Canadian cannabis producers like to pump up that they're waiting for the U.S. market to open up. One of the headlines here, Tilray put that its U.S. cannabis strategy is in place to strike with potential drug policy reform. And so this is a little bit concerning because I think a lot of people just don't realize what this actually means. And I was watching Jim Cramer's Mad Money, and even he doesn't obviously have a good grasp on this because marijuana reform, the type that might happen in the U.S., is not going to be full on legalization. It's going to be classifying cannabis instead of Schedule 1 down to maybe Schedule 3, so it'll be easier to research it. So companies in the U.S. might have a better chance of potentially listing on a major exchange, but that alone is not necessarily going to mean that Tilray Brands, Canopy Growth, they're going to be able to cross into the U.S. and start selling there. Legalization is still an incredibly complex process because you got to worry about taxes, you got to worry about advertising, all these sorts of issues. How revenue is going to be distributed, who's going to be able to have licenses. It's a really complex thing that's going to take a really long time, and they aren't even in the early stages of that. When they're talking about policy reform, they're talking about reclassifying stuff. And I'll give you one of the examples where it's a little bit concerning, where Kramer had Irwin Simon, so Tilray's CEO, talking about legalizing Florida potentially legalizing marijuana for recreational use. Now that sounds great for the cannabis industry, but has no effect on Tilray or any cannabis producer in Canada, just because they technically can't be operating in Florida or anything else like that. So the danger is a lot of people read into stuff like that and think, oh, that's great news for Tilray, but it actually doesn't mean anything for Tilray anytime soon. As long as that federal ban is in place on marijuana, it's going to not do anything for Tilray. And while it may say that it has a U.S. cannabis strategy in place, I'll just give you one example of how flawed that strategy is. So a few years ago, they acquired a majority position in MedMen. So this is a multi-state operator in the U.S. that wanted to be sort of like have Apple-like stores in cannabis, where it's like they're really large, look like Apple stores. So they tried to develop that kind of image. Now, unfortunately, this has been one of the worst run MSOs. There's been lawsuits involving the company, issues with their past CFO. I mean, it's just an entire mess. And right now, if you look at the stock, it's basically worthless. It's zero. Market cap of 1.5 million. And this was one of the companies that was the cornerstones of Tilray's strategy for investing into the U.S. Right? And at that time in 2021, to give you another example of how outlandish Irwin Simon is, the company was forecasting $4 billion in revenue by the end of fiscal 2024. Well, Tilray is nowhere near that target. 188 million as of Q3 2024. So if you times that by 4, that's a run rate of around less than 800 million for a full year. Whereas before they were pumping up, they're going to be at 4 billion by this time. Growing in Europe, in the U.S. So the danger with Tilray is their CEO Irwin Simon really likes to pump up his company a lot. And the danger for people who aren't aware of the complexities of investing in cannabis stocks is that, that was unrealistic back then and still unrealistic anytime soon. And legalization in the U.S. isn't going to happen potentially for a long time, even if Joe Biden does make some reform as far as reclassifying cannabis. I mean, there really hasn't been a whole lot of movement on that, and it's gonna take a really long process for anything to happen, just because that's a really complex bill that would have to pass as far as legalizing and things like that. And don't forget that there are plenty of competitors already in the U.S. that are operating, uh, many multi-state operators like Curaleaf, True Leaf Cannabis that would re- already have staked out positions and be fighting for market share. So just because legalization might happen at some point doesn't mean that Tilray stock is going to be a good way to invest in that. Just because they've proven that they are not really good at picking partners to work with, where it's acquiring Hexo, acquiring nodes in MedMen. They aren't exactly the best company in terms of picking who to partner with and making good moves in the industry. So sure, while the stock was down 20% today, and that's largely to do because of a revenue miss, in the bigger picture, there's a lot more wrong with this stock that are reasons you should stay away from it. So I don't invest in the company. I don't short it. I don't have any positions in it. But I think it's a public service to tell people just how risky of an investment this is. Just because over the past 5 years, Tilray has just been a horrible investment, and there's not really a whole lot of reason to expect that it will get any better. I mean, occasionally it'll bump up in price because people see news about U.S. cannabis reform or bills or things like that. But realistically, there's little reason to expect anything is going to happen anytime soon. And if you're investing based on that, that's a really risky proposition because this stock, as you can see, is very volatile and has generally been going in one direction over the past 5 years. So it's a really risky stock. So invest at your peril because this is one of the worst stocks you could buy. And what makes it more dangerous, it's got a CEO that's really reckless when it comes to pumping up the stock.